Ever wondered about the unsung heroes of the financial markets? The ones who seem to dance amidst the fluctuating prices, buying and selling with a speed that might make your head spin? Are they shrewd investors carefully analyzing long-term value? Or could they be something else entirely, perhaps even speculators? I'm talking about jobbers. Now, the term jobber might sound a bit old-fashioned, like something out of a black-and-white movie about Wall Street. And in many ways, the traditional image of a jobber shouting orders on a physical trading floor is largely a thing of the past. The rise of electronic trading has fundamentally reshaped the financial landscape. But the function that jobbers performed, the role they played in the market ecosystem, that's still incredibly relevant today, albeit often under different names like market makers or liquidity providers. So, who were these jobbers and what did they actually do? Imagine a bustling marketplace. Buyers want to buy, sellers want to sell. But what happens if, at a particular moment, there aren't enough buyers for all the sellers or vice versa? That's where the jobbers stepped in. They were essentially professional intermediaries, standing ready to buy when there were more sellers than buyers, and ready to sell when there were more buyers than sellers. They provided continuous liquidity to the market, ensuring that there was always someone on the other side of a trade. Think of them as the oil that kept the gears of the market turning smoothly. By being willing to hold an inventory of securities, they absorbed temporary imbalances in supply and demand. This continuous buying and selling helped to narrow the bid-ask spread, the difference between the highest price a buyer is willing to pay and the lowest price a seller is willing to accept. A tighter bid-ask spread means lower transaction costs for everyone else participating in the market. 1. Advisors.vanguard.com. Advisors.vanguard.com. Now, here's where the question of speculation starts to creep in. How did jobbers make money? They profited primarily from this bid-ask spread. They would buy a security at the bid price and then aim to sell it shortly after at the slightly higher ask price. This small profit, multiplied across a high volume of trades throughout the day, was their bread and butter. Notice the emphasis on shortly after and high volume. The traditional jobber wasn't typically holding on to assets for the long term, hoping for a significant price appreciation based on fundamental analysis of the underlying company. Their focus was on capturing those small, incremental profits from the constant flow of buy and sell orders. This brings us to the heart of the matter. What exactly is speculation? At its core, speculation involves trading an asset with the expectation of profiting from fluctuations in its market price, rather than from its fundamental value or income generation. Speculators often have a shorter time horizon and are willing to take on higher risk in pursuit of potentially higher returns. So, looking at the jobber's modus operandi, there are certainly elements that align with this definition of speculation. Their profit model relied on predicting and capitalizing on short-term price movements, even if those movements were just fractions of a penny. They weren't necessarily concerned with whether a company's earnings were going to beat expectations in the next quarter. Their focus was on the immediate supply and demand dynamics in the market. However, it's crucial to make a distinction. While jobbers engaged in trading based on price fluctuations, their primary role wasn't necessarily to bet on the direction of the market in the same way that a pure speculator might. Their core function was to provide liquidity, and their profits were a byproduct of fulfilling that role. Think of it this way. Imagine someone who buys and sells foreign currency at an airport exchange. They are profiting from the difference in the buy and sell rates. While they are technically trading on price differences, their main purpose isn't to make a large bet on whether a particular currency will soar or plummet. They are facilitating the exchange of currencies for travelers. Similarly, jobbers facilitated trading in the stock market. Furthermore, jobbers often operated under specific rules and regulations. For example, on the London Stock Exchange, the traditional jobbing system involved firms being obligated to quote prices and trade on request for the securities they covered. This obligation to provide liquidity, even in volatile market conditions, distinguishes them from pure speculators who have the freedom to sit on the sidelines if they deem the risk too high. The rise of electronic market makers has further complicated this picture. Today's high-frequency trading firms, which often fulfill a similar role to traditional jobbers by providing liquidity, utilize sophisticated algorithms to execute millions of orders in fractions of a second. Their strategies can be incredibly complex, involving statistical arbitrage and other techniques that blur the lines between pure liquidity provision and active speculation. Some argue that these modern market makers are indeed engaging in speculation on a massive scale, leveraging their technological advantage to profit from tiny price discrepancies. Others maintain that their primary function remains liquidity provision, even if the methods have become far more advanced. Consider the impact of jobbers and market makers on market efficiency. By constantly quoting prices and facilitating trades, they contribute to a more liquid and efficient market. This means that buyers and sellers can generally trade more quickly and at fairer prices than they might in a less liquid market. This efficiency benefits everyone, from large institutional investors to individual retail traders. A purely speculative market, on the other hand, might be characterized by greater volatility and wider bid-ask spreads, as participants are primarily focused on betting on price movements rather than ensuring a smooth flow of transactions. So, to circle back to our initial question, is a jobber a speculator? The answer, as is often the case in finance, is nuanced. With that said, thanks for watching, and until next time.